Hello, fellow RoboCapitals. Hope you're well. So we had some more inflation data come out today. It is not the CPI. It's actually the PPI and a slew of other economic data that shocked the market. So let's get right into it. Let me do a screen share, and we're going to go over to Market Watch first and foremost to look at this calendar so we can get a summary of the data that's come out today. And then we're going to go over to the BLS and look at their report and see if we can really connect some dots. So first and foremost, let's go over to, where were we here? Market Watch, I had it up. There we go. And we've got initial jobless claim. So as you guys know from watching my videos, I've been paying a lot of attention to the labor market. I think that's really the key if you want to try to time an economic slowdown or a recession. I think the probabilities that we go into a recession very, very low, with the initial claims at 229 where they are right now. But that's not to say that the economy is strong. Those are two completely separate things. Just because we might not be in an official recession right now, and who knows, these numbers might get revised. But just because we're not there now doesn't necessarily mean that the economy is booming. It doesn't necessarily mean that the economy is strong or the economy is resilient. As most of you know, the bottom 75% are really struggling right now. And you don't have to take my word on it. Just look at McDonald's or look at some of these other restaurants that cater to lower income demographics. I would also point just to the obvious anecdotal evidence that if the economy is booming, why is it that every single Walmart I've ever been to in the United States over the last, call it 3 years, has to lock up everything behind a cage like it's somehow selling gold or something like that, just to get a pair of $2 cuticle scissors from China that will in the future cost $2.50, of course. But then they're really going to have to up their security. My goodness gracious. But if the economy is so strong, why is it that you have to lock up cuticle scissors? Just ask yourself that question.
Well, George, I would also say the last Walmart I was in was basically a war zone. I mean, I was in Baltimore.
Oh, why would you go to a Walmart? Why would you go to a Walmart? Secondly, why would you go to a Walmart in Baltimore of all places? Goodness gracious.
The last time you were in a Walmart, it was almost a war zone. You almost got in a fist fight with that one dude.
Well, the guy wanted to fight me because he was on meth. He was just completely cracked out of his mind. And, you know, he's like no shirt at his, I won't describe him, but he was obviously homeless and on a massive amount of drugs. But, well, maybe that's why they have to lock up the stuff. But my point is, if the economy was booming, you probably wouldn't have as many homeless people. You probably wouldn't have all these people on drugs. They would have better alternatives, or at least they wouldn't take that path to begin with. So anyway, getting back to this here, initial jobless claims 229. U.S. retail sales came in low, but on expectations at 0.1. Now, keep in mind, this is not adjusted for inflation. So if you adjust for inflation, that's going to be a negative number. We got retail sales minus autos, and this is 0.1% as well. Now, this is down from expectations. And this makes sense because I'm sure a lot of people are buying automobiles as soon as they could to front run the tariffs, if they're thinking about that at all. I mean, that's what I would have done. If I was in the market for a car, once Liberation Day hit, I'd be like, okay, let me get one. Let me get one ASAP. So that bumps, that's probably why they were expecting the 0.3%. Well, actually, no, that's not right, because minus auto sales, they were expecting more. Huh, that's interesting. I thought it would have been reverse. But moving on here. Now, this is where they actually made a mistake, Market Watch, that is. Because when I first saw this and I saw bond yields, which we'll get into in a moment, I thought, bond yields are really collapsing today, which would lead me to believe that this PPI number was soft. And I'm like, 0.5? And they were predicting 0.3? What? This doesn't jive. And in reality, it wasn't a 0.5. It was a negative 0.5. So this is a huge miss. I mean, a massive, I don't know. I'm sure I have, but right off the top of my head, I cannot think of a bigger miss in all my, let's say, 5 years of doing videos here. I mean, to see an 80 basis point miss on something that was only predicting 0.3 to begin with, I'm sure I have, but I just can't think of one right off the top of my head. Then core PPI, another huge miss, but not as severe at 0.3. And that's what the expectation was. And this was negative 0.2. So then we've got the year-over-year PPI 2.4 and core PPI down to 2.9, which, by the way, just a couple months ago, and we'll get into this over at the BLS, if my memory serves me right, it was up at 3.6, 3.8. So massive disinflation. Now, I know a lot of you are saying, oh, this is a joke, this is government numbers and blah, blah, blah. And yeah, that's true. I'm not saying that the actual inflation rate or producer prices rose by 2.9% over the last 12 months. I'm just using this as a proxy for the trend, right? That's what we're trying to figure out here. And then let's see, manufacturing. So Empire State was a big miss. Well, not a big miss. It was expected to decline by 9%. We had 9.2. Now here is a little bit better than expected. The Philly Fed manufacturing survey was supposed to come in at a negative 10, and it was a negative 4%. So that's, I mean, it's not like a negative number is good, but slightly better than expectations. Industrial production, that was a miss. The capacity utilization, that was a miss, but just slightly. Business inventories, that was a miss. Home builder confidence, that was a miss. I mean, you got to look at this and say, I don't know. Maybe the economy is not running on all 8 cylinders right now. Maybe we're kind of sputtering along on 4. That's the conclusion I come to, along with all the other stuff. Now, does that mean we're going to go into an economic collapse that looks like the 1930s tomorrow? Probably not, or else you wouldn't see this jobless claims at 229, and you would see non-farm payrolls at severe negative, like we were talking about yesterday. But again, this in no way, shape, or form, just because you're not in a technical recession, although GDP is negative, but even if you're not in a technical recession, look at this stuff and compare it with everything that we're seeing from the airlines, from the restaurants, and just the anecdotal evidence, and ask yourself, is this what you would expect to see? And by the way, yesterday we were talking about student loan delinquencies skyrocketing. That may or may not be due to the economy. But then we were also talking about credit card delinquencies, highest rate since 2007, 2008. So I don't know how that's a sign of a booming economy. But let's get into the specifics over at the BLS website. So here, PPI, final demand components, 1 month percentage change. So in goods, it says we were slightly negative. I think they kind of round maybe to the nearest. Yeah, I think they round on this one. But anyway, bottom line, about flat. Services, this is the big decline here. The services came in at minus 0.7. Minus 0.7. And that is, I believe, something that was rather sticky before. Let's read this. The producer price index for final demand fell 0.5 in April. Prices for final demand decreased 0.7 for services, while the index for final demand goods unchanged. On an unadjusted basis, the index for final demand rose 2.4. Okay, so now let's go and let's look at the release here. So this is going to give us some more details. Prices for final demand, less food, energy, and trade services edged down 0.1. Okay. First decline since falling 0.8 in April of 2020. Let me read that again. Prices for final demand, less food, energy, and trade services edged down 0.1% in April. The first decline since falling 0.8 in April of 2020. In other words, the first decline since the cerveza sickness. For the 12 months ended April 2025, the index for final demand, less food, energy Okay, that's where we got the annual of 2.9. Here we go. This is what I wanted to see. So we've basically got a spreadsheet, and this is the field or the line that has the most recent data. And you know what's interesting here too is look at the month over month, a month ago unadjusted. Okay, so that's what I was looking at, that we were at 3.6, excuse me, I think I said 3.8. We were at 3.6 in February, and we've gone down to 2.9. Here's where we're at 3.8. So this, let's see, ago, what is it? Let's see, so change in fund 12 months ago. Okay, so this is year over year. And this is basically what they're considering core. Okay, that makes sense. So this is not month over month. This is year over year. This is core, and this is overall. So overall, we've gone from 3.8 in January down to 2.4. That's a big drop. Big drop. And man, transportation has been negative many months over the past year, that's for sure. But then we look at April specifically, and it's negative, negative, flat, negative, negative. We've got a positive 4 here when we look at less food and energy on the demand for goods, or final demand goods, excuse me. Then we've got a negative 1.6 on the final demand services for trade. Then we've got a negative 0.4, negative 0.3, and then the 2.4 and 2.9 we talked about. So there's a few things going on here. First and foremost, for everyone, 99% of the people out there on social media and the mainstream media, what have we heard? We've heard stagflation, 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 stagflation. I mean, it's just nonstop, this drumbeat. And what they're implying by saying stagflation is they're implying that we are going to go into an economic slowdown or contraction, recession, whatever. Unemployment rate is going to spike, and we are going to see an acceleration of just the CPI. We'll just use that as a proxy. So we've got a 2.4, or had a 2.4 CPI, and the idea is this is going to go to 3, 3.5, 4, 5, 6, 7, and it's going to accelerate. This is the idea of stagflation. It's not just high inflation. And by the way, at 2.4, whatever, it wasn't astronomically high based on the government's numbers, which is what we have to go on because we're trying to figure out what the Fed is going to do. Because let's remember their target, not for the CPI, but for overall inflation, I think it's the PCE, or the core PCE, is 2%. So a 2% bogey is kind of what you're aiming at, regardless of what metric you're using. If you're one of these, 900 PhDs at the Fed. So the fact that you're at 2.4, it's not like that's astronomically high inflation. That is not 1970s inflation. And even if you look at shadow stats or something like that, which I tried to look at, but it looks like they haven't updated it. Looks like in a couple of years, if I'm looking at it correctly. But even with that, the trend is going to be down significantly since the summer of 2022. And even if you're measuring it the way we did in the 1990s, let's say, I don't know that inflation would be, even by that metric, higher than, let's just say, 5%. So anyway, this is not stagflation. And then the stagflation, what they were implying by that is that you're going to see an acceleration. So we're going to go from 2.4 to 3 to 4 to 5, etc. Right? And what we've seen during that time is we've seen the CPI go from 2.4 down to 2.3, and now we've seen PPI almost negative straight across the board. This is, now I'm not saying this is great news or anything, but what I am saying is this is not stagflation. This is this is not what you would see in stagflation, which makes a lot of sense because I'm always talking about robbing Peter to pay Paul. I say that till I'm blue in the face. And what I mean by that is even if you're increasing stuff on tariffs, which we still may see, but even if we do, that's just a high watermark. It's not like it accelerates. It's just the price level adjusts. But then what you're doing is if those people choose to buy those products from Walmart that have increased in price, the price is adjusted. If their wages aren't going up and their purchasing power is going down, and therefore they're having to take that percentage of their paycheck that would have been allocated to domestic goods and services, it would have been allocated to, let's say, things they want, and they have to allocate that to the things they need at higher prices. So it's this kind of equilibrium thing where, sure, you can get disruptions, you can get noise up and down, but if you zoom out and look at it over, let's say, a 6-month time frame, it's very difficult for the basket of goods to increase. The entire basket is what I'm referring to. And it's almost impossible for that basket of goods to not just increase, but to have an accelerated increase. So again, we go from 2.4 to 3 to 4 to 5 to 6 to 8 to 9. That if you don't have nominal wages keeping up, and if you don't have the money supply really cranking things out, and I'm not talking about the Fed, I'm talking about the banking system. If liquidity is tight, it's not impossible, because you could have a huge supply shock, and you can have that supply shock get worse and worse and worse. So I can imagine an environment where that would be possible, but the probability is extremely low, unless, let's just say, whatever happens with tariffs creates an environment where we go back to the same level of supply shock we saw during the cerveza sickness. And that, but even if we had that, those prices would just adjust higher. They wouldn't accelerate. And so, again, we always talk about probabilities on this show. There are no certainties, only probabilities. But that's why I keep kind of pounding the table that the probability on anything other than just kind of disinflation, or just kind of flat, a little bit of noise up, a little bit of noise down until we get a recession, and then you're going to get some serious disinflation. I don't care what tariffs are doing. That to me is always my base case. And it's not that I'm just pulling this out of the air. It's not that this is just my opinion. I'm just going back and looking at how things play out throughout history. And I know I pulled up this chart a bunch, but if you look at long-term trends, and this is it's GDP. This is the wrong one. I thought I had it up, but that's okay. We'll just do, I know exactly where it is. And by the way, if you guys haven't been on this website, you got to check it out. It's awesome. I really like this one. I don't know who does it, but man, they do a great job. Okay, so this is the chart that I like to refer to, because everyone always talks about the 1970s as far as the stagflationary decade, but you'll notice this red line is CPI. And even throughout the 1970s, when we had an economic slowdown, when unemployment spiked, you did not get an acceleration of inflation. You had disinflation. You just go back throughout U.S. history, and you just see this over and over and over and over again. It's very, very difficult to have a contraction, an economic contraction, unemployment spiking, and having inflation go higher and higher and higher. So again, that's why it's my base case. And that's why, although these numbers shocked the market, as far as the PPI numbers and what we saw in the CPI, I wasn't really that shocked. I think what we have to do is ask ourselves, now what if you're the Fed? Like, I guess what they can do, or what they can argue, is, well, we haven't seen all of the price increases yet from the stuff coming in from China. There's a lot of disruption. Maybe they're going to argue supply chain disruptions, and therefore we don't really know how inflation is going to play out over the next 3 months. We're going to keep rates at 4.3%. But I don't know how you can argue that, because even if tariffs do increase prices, again, that's not really something the Fed can do anything about. Like if Donald Trump increases tariffs by 25% on vehicles coming into the United States. How on earth does the Fed adjusting their Fed funds rate by 25% up or down or staying flat, how does that make a difference? The answer is it doesn't. It doesn't. And let's remember that a vast majority of the curve is inverted, meaning it's under Fed funds. And therefore, if you're just dropping Fed funds by 25 basis points, you're just dropping the front end, basically from 1 month to 6 month T-bills. So by keeping 1 to 6 month T-bills above the 2-year Treasury, is that really going to help inflation if Donald Trump increases the price of these vehicles? No, it's not going to do anything to the price of those vehicles. Nothing. Zero. Nada. So I don't really understand the Fed's rationale here. Granted, I don't think they have a lot of power over interest rates, or I don't think they're, you guys know my position on the Fed. But if I'm looking at this through a Fed-centric view, like the mainstream media does, I'm asking myself, why on earth are they not cutting rates? Because there's really nothing that would lead me to believe that you've got to worry about an acceleration in consumer prices. And even if you were worried about the tariffs, that's just a price adjustment on components of the basket. That's not going high. That's not to infinity and beyond. That's not what we saw during the 1970s. So we'll have to see. I think the odds are probably still the same as far as the Fed only cutting 1 or 2 times throughout the rest of 2025. So we'll have to see if those odds change to the upside or the downside. It's going to be an interesting year, that's for sure. But what I can tell you guys is I've made some big changes to my personal portfolio as a result of what has been happening. And if you guys want to check that out, you can go to georgegammon.com/pro. I'm going to be doing a webinar live for the Rebel Capitalist Pro members this Friday, 11 a.m. Eastern time. And I'm going to be going over those significant changes that I made and why. I'm going to be going over the indicator that we were discussing yesterday and dive into each and every component and kind of the back testing for some of that, but a lot of actionable stuff. So if you guys want to participate, again, you can go to georgegammon.com/pro and you can sign up for $1 or go ahead and sign up and you can be a part of that live stream Friday, 11 a.m. Eastern time. If you can't make it then, don't worry about it. As long as you're a member, you can go ahead and see the archive on the homepage of the forum itself, so you can watch it at your leisure. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market, capitalism, and we'll see you in the next video.